Hola, si estás viendo este vídeo es porque eres seguidor de la actividad del Instituto. Si te gusta lo que hacemos y lo que decimos, puedes apoyarnos. ¿Cómo? Es muy sencillo. Puedes hacerte miembro del Instituto o miembro del canal de YouTube. Con la membresía contarás con descuentos y también con contenido exclusivo. Además, estarás ayudando a divulgar las ideas de la libertad. ¡Anímate!
Muy bien, amigos del Instituto Juan de Mariana, estamos hoy en la Universidad Francisco Marroquín, un viernes más, para dar pues una conferencia que además es de especial interés. Hoy vamos a hablar de lo que parece un oxímoron, ¿no? De la banca libre. Digo que parece un oxímoron porque es uno de los mercados con diferencia más regulados y además está controlado por el ojo de Mordor, que son los bancos centrales. Si hablamos de banca libre, pues enseguida pensamos en nombres como Friedrich Hayek, Stephen Horvitz o George Selgin, a quien tenemos aquí con nosotros. George Selgin es profesor del Terry College of Business de la Universidad de Georgia y es decano del Cato Institute. Y es autor de libros como, por ejemplo, en español está traducido uno de sus libros, que es La libertad de emisión de dinero bancario, y creo que también se va a traducir en breve Less Than Zero. Así que, sin más, os dejo con George, que nos va a hablar de la libertad de la banca libre en los Estados Unidos y en Canadá. George, it's your stage.
Thank you. Welcome, everybody. Thanks for the opportunity to speak to you. This is going to be fun. I want to just correct my vita a little bit. I'm actually a professor emeritus at the University of Georgia, where I retired from teaching almost 8 years ago. And I'm now director emeritus of the Cato Center for Monetary Alternatives, because I stepped down from that post largely so that I can move to Spain next year. So anyway, I'm very emeritus, just so you know. So the advertised title of my talk is Free Banking in the United States and in Canada. But I should say that my theme is really more fundamental than the title suggests. What I really want to tell you is how important history is for the understanding of money, and in this case, for the understanding of banking. Moreover, I want to impress you with how important it is to know not only the history of one's own country, but to know what has happened in other countries, so you can have perspective. That is, so you won't have an insular view. You'll be able to see the other possibilities before reaching conclusions about what's possible in any one place. And the reason I think this is important is I don't know about Spanish economists, but I can tell you American economists are extremely insular. In fact, it's worse than that. Most monetary economists in the United States don't really know much monetary history. And this is true despite what John Hicks quite correctly said about monetary theory. He said, I don't recall his exact words, I was going to look him up, but my phone's about to run out of energy. But in one of his works, Hicks said that there's a much more intimate connection between monetary theory and monetary history than there is between any other field in economics and the history of what went on in that other field. And I think that's correct. So you really have to know monetary history to be a good monetary theorist or monetary economist. And most American monetary economists frankly don't know much history. They don't even know much history of their own country. That is, they don't know much of the banking and monetary history. They think they do, but they get it wrong. What I want to do today is, first of all, talk about what people think happened in banking history in the United States, particularly before the Civil War. Then I want to tell you what actually happened then and also afterwards. And then I'm going to talk about what happened in Canada. Because as I hope to make clear, it isn't until you learn what happened in Canada that you really can understand how badly misunderstood U.S. experience is. So let me start with what most economists in the States, and I say this on good authority because I've had to debate them. I'm intimately aware of what they think and what they know and how different those two things are. What the average economist thinks happened or thinks is true about 19th century banking history in the United States includes the following. First, particularly before the Civil War, there was hardly any regulation of banks. It was a period of laissez-faire banking. Anybody could start a bank. There were very few regulations. The federal government didn't regulate at all, and that happens to have been true for the most part. But neither did the state governments regulate. So banking was as free an industry as any, and freer than any time since. And it was a disaster. Not only were there very frequent bank failures, but there were all kinds of fraudulent banks, which have come to be known as Wildcat Banks. This is supposed to refer to the fact that even if the bank's notes said that the bank was located in some relatively populous place, in fact, the true location of the bank was some remote spot where wildcats lived, but not many people. And that's where you would have to go to try to redeem the note. But in fact, there wouldn't be anybody there because by the time you did, everyone would have run off to Bolivia with their loot. So this is what people believe. They also believe that this was a period and that the whole 19th century was a period of severe monetary instability, both because of the decrepit nature of the banking system, but also because of the gold standard. The gold standard is supposed to have been responsible for major crises, not just before the Civil War, but afterwards in 1873, in 1874, in 1884, in 1893, and the biggest of all in 1907, none of which, with the Federal Reserve's creation only bringing this instability to an end, or at least for a time. This is what people think they know about U.S. banking history. Oh, I could go on. Yes, there was a Great Depression. We know that, and many banks failed in the United States. But this, too, has been blamed on two factors. One is still the gold standard, which supposedly interfered with the limited the potential for monetary policy to respond and create an adequate supply of money, contributed to the deflation, supposedly. And also the other factor was that we didn't have bank deposit insurance. And we all know from reading Diamond and Dybvig 1983 that without deposit insurance or a very alert central bank, you're going to have severe banking crises. So now we have an alert, modern central bank, we have no gold standard, and we've had deposit insurance for some time. And as you know, there have never been any more crises in the United States since the 1930s. That isn't true, but I thought I would just say that so you could think about the implications of the conventional view. So what I want to do is talk a little bit about what actually happened in the United States, both before and after the Civil War, and show you how much of what I just described is actually true and how much is actually not true. And then I want to talk about Canadian experience so that you can see that the fallacies go even further than what a correct understanding of U.S. experience alone suffices to reveal. So let's talk about banking before the Civil War in the United States. It isn't true, first of all, that banking was unregulated anywhere in the United States at any time. It's always been a fairly heavily regulated industry, though the degree of regulation and the nature of the specific regulations varied from state to state and also between states and territories, because, of course, during the period we're talking about, the further west you went, at some point the states stopped and you just had the various territories. I used to tell my money and banking students that if you wanted to understand the structure of the banking industry and get a grasp of the number of banks, let's say around 1837 or 8. By the way, let me just say, the federal government was involved in banking twice in the years before the Civil War. At first, it created the first Bank of the United States, a federally chartered bank with its headquarters in Washington. That lasted for 20 years. It was a very controversial institution, and its charter was not renewed after the first 2 periods of 10 years each. Then there was a gap. Then the second Bank of the United States was established in 1816, and that lasted 20 years, and it was controversial, and it was killed off in 1836. So let's talk about what happened after 1836, because remember, we're trying to address the claim that banking was unregulated. So let's now do so by taking a period when we know the federal government isn't regulating things and try to understand what's happening at the states level. Anyway, around this time, I would tell my students, if you wanted to understand the structure of the banking industry, if you had a map of the United States, let's say I've got a map of the United States and I'm looking at it, well, let's have it look at it your way, okay? So Texas is down here, Canada is up here, and here's New England, Maine, and all that. And this, of course, is the far west. If I took a salt shaker and shook it on Boston, like that, above Boston, we let the little grains of salt spread out as they might, and ignore the ones that went in the ocean, that would give you a rough idea of what the distribution of banks was like. Quite a few in the city of Boston itself. Massachusetts has a fair number. New England, also pretty good. New York. As you get beyond that region, beyond the further west and the further south, the fewer the number of banks. And then you have a bunch of states in the Old West where they just had one bank by statute, right? They had a state monopoly bank. And then if you go even further to the territories and some states, there were none. And not just because no one bothered to start a bank, but because it was against the law to have a bank. Banking was prohibited in much of the West and in all of the territories. It was not legal to have a bank. No charters were available. And in those days, I should mention, every bank that was established by a specific charter. What I mean is that the proponents, the people who wanted to start a bank, had to go to the government and get the legislature to meet and pass a law enabling that bank to exist. There was no such thing as a general incorporation procedure for banks. There was no way you could start a bank unless there was an actual vote on your bank by the legislature of the state in question. That's in the places that allowed banking at all. Of course, in the places that prohibited banking, tough luck. So there's nothing like laissez-faire. There's nothing like freedom of entry. It's relatively open entry or relatively generous charters being granted in the Northeast, and then more and more restrictive arrangements till there's no banking at all. Now, in those states where more than one bank was chartered, there was, as you might well expect, quite a lot of corruption involved often in getting a bank passed, because the legislature you had to get a majority. So bribery was involved and lots of wheeling and dealing. It was called the spoils system because it was so corrupt. Sometimes the corruption was very crude, when you just pay off the legislatures to get enough of them to vote for your bank. In other cases, it was a little bit more shall we say, public-spirited, where you could have a bank if you provided loans for a school or if you did these other civic-minded things. But it wasn't simply a question of meeting certain regulatory conditions and then you're in. It wasn't a question of showing you were a sound bank and you're in. It was a question of doing favors for somebody. And this was a notoriously corrupt situation, even in New England. Now, I say even in New England because I'll come back around to this. New England had it had the best banking system in the United States. And I think this was partly because there was more freedom of entry there and more real competition, which was utterly lacking elsewhere. And as happens in industries generally, having more competition meant having higher quality product, in this case, banking services. But what really made New England stand out is the function that was performed by one particular Boston bank called the Suffolk Bank. But I don't want to tell you about that yet. Remind me to get back to it if I seem not to have done so. If I start talking about Canada before I talk about the Suffolk Bank, let me know. What I want to talk about instead is how things changed beginning in 1837. In that year, people started to get disgusted with the spoils system. More and more people realized that banking should be treated like a business where getting a bank started didn't require bribing the legislature and having the legislature vote at all on one particular bank. So, starting with the state of Michigan, they passed new laws were passed, which unfortunately, for the proper understanding of banking history in the United States, were called free banking laws. This has created a great deal of confusion because naturally people assume that what that meant was that where these laws existed, anyone could start a bank and there was no regulation. Because we also know that the expression free banking sometimes does mean that. When Larry White and I write about free banking, we have the Scottish system in mind and sometimes the Canadian system, but we're really talking about something approximating unregulated banking. But these laws, though they were called free banking laws, didn't create unregulated banking systems. They all had regulation, and they all had some rather serious regulations. And here's the thing, the regulations often caused the systems to be terrible. So in other words, if they were bad, and some were very bad, they were typically bad not because there wasn't enough regulation, but because there was very, very harmful regulation. Let me talk about Michigan's case. It was the first free banking state in 1837, and it was a disaster. Michigan is actually the state where almost all the wildcat banking that people talk about now took place. It was the one place where it was not exactly common, but more common than anywhere else before or since. I think the number of wildcats might have numbered 50 to 60 in that episode, which only lasted 2 years. The law had such disastrous consequences that it ended in 2 years. And so you had this brief period of a disastrous law. Michigan's law actually resembled the later free banking laws of other states in some respects, though not in others, because they weren't all so bad. I should mention that ultimately about 13 states passed laws that were called free banking laws. Michigan's was typical in 2 respects. First, banks couldn't have any branches. So every bank was a single office bank. This was, by the way, an important problem of bank safety and stability for the whole of U.S. history. The fact that many banks couldn't branch in most states, you couldn't have branch banking, and all of the free banking states disallowed branch banking, meant that the banks in those states tended to be under-diversified, tended to be highly vulnerable to local shocks. So they were, just by virtue of that regulation alone, relatively more likely to fail than any bank that could branch. That was one of the features of Michigan's law and of all free banking laws: no branching. So if you had a bank in one town called whatever, the Farmers Bank of Peoria, that bank didn't have another bank branch anywhere in the state, anywhere in the country. Yeah, that was it. And its loans would all be local. You can imagine how vulnerable such a bank would be. The other restriction that every free banking law had was to issue banknotes. The banks had to secure the notes by backing them in particular securities. So if I'm a bank and I want to, I have, let's say, $1,000 of notes outstanding, and these would be denominated in, the dollars back then would have been at first silver units and then later in the period in question gold units. Because we had bimetallism, and it's an alternating standard in practice. Then if you had $1,000 of notes, you had to have 1,000 or perhaps more of specific securities backing the notes. So in other words, the bank couldn't just make loans, couldn't buy whatever assets it wanted to. It had to have assets dictate that according to the rules of the state. What many states, including Michigan, did, they put their own state securities on the list of eligible bonds. Sometimes they made them the only choice. But at other times, they included some other securities that were even worse. When the governments were in bad fiscal shape and they put their own securities made their own government securities the only eligible collateral or backing for notes, then the banks were basically told, you can be a bank, but you have to buy our junk bonds. And if those bonds lost value, the banks failed. All of the free banking states had this bond deposit requirement. Superficially, it looks safe, right? Oh, well, the bank has all these securities that are held by the state authority. They give them to the state government and keep them, the state government holds them. If the bank fails, they sell the securities and the notes can be redeemed if they're still outstanding. But if the bonds that are specified by law are themselves risky and lose value, they become the cause of the failure of the bank. And this was the most common cause of failures of free banks, not just in Michigan's notorious case, but in all of the free banking systems. The banks didn't fail because they were fraudulent Wildcat Banks, though some of that took place, especially in Michigan. For the most part, the problem with free banking, so-called, was the bonds that the banks had to buy as a condition for doing business. So this is a good example of how it wasn't the lack of regulation that caused failures of so-called free banks. It was bad regulations that actually made the banks fail. And this has been very well documented now by economic historians. Of course, the lack of diversification through lack of branching compounded the problem, because that meant that even a bank, most banks relied on note issue back then. Deposits weren't as important as they are today. Banknotes were the most important bank liabilities. You have to keep that in mind. But because of the lack of branch banking, even a bank that had a lot of deposits and to that extent was free to diversify its asset portfolio couldn't diversify it all that much because everything had to be local loans. So between the lack of diversity on all liabilities that's a result of unit banking, no branch banking, and the even stricter conditions for backing banknotes, you have banks that are very, very undiversified and often holding very doubtful securities. No wonder they failed. Michigan's first experiment was the worst disaster. Of the other 12 states that engaged in free banking, some of them had more successful experiences. Others also had bad experiences. I think Minnesota was a bad case. I'm pretty sure that Indiana was a bad case. New York was a pretty successful case. It all depended, or much of it depended, on the quality of bonds that the state legislatures deemed suitable for backing the notes. But already we've seen that the myth that this was a failure of laissez-faire or lack of regulation is already exploded. What the economists have done who claim that this is what happens when you don't have enough regulation is to take the name of these laws, free banking, too literally, instead of asking what were the laws in fact? What did they involve? What regulations were there? They just assumed that there couldn't be any because it says free banking, see? And to this day, this is a very big problem. Right now in the United States, of course, we have a big debate about stablecoins. Well, scholarly articles and arguments by regulatory authorities repeatedly refer to the free banking era, that is the U.S. antebellum banking era, and claim that this was an example of what happens when you don't have enough regulation and anybody can issue money. And it's an example of how you get outbreaks of bank failures everywhere and fraudulent wildcat banking. Now, I counted all the wildcat banks that actually existed according to careful analysis in the antebellum period. I think that depending on what criteria you use, because there are different ways to define a wildcat bank, but I looked at all of them. The range of total wildcat banks is somewhere between 60 and maybe 200 and something, maybe 250 tops. At a time, this is throughout the whole period, right? All the wildcat banks that came and went, no more than 250. During that same time, the total number of banks established in the country was, I think, something like 3,500. It may have been more. So we're talking about a relatively small proportion of banks that engaged not 3,000, over 7,000 banks. So it's a small fraction of banks that could possibly have qualified as wildcat banks. But even those could be shown to have been outgrowths of the regulatory conditions, because a lot of them took advantage. Remember, if the state says you're a bona fide bank as long as you back your notes with certain securities, guess what? Any bank that got a charter could buy all of the securities it wanted because the state couldn't refuse a free bank's notes in exchange for its own securities if they were on the list. So banks would get set up to just acquire all these securities on speculation using leverage, and then they would sell them for whatever they were worth, or they would skip town with whatever assets they had gotten hold of, and that would be their way of profiting. So you've created a situation where fraud is actually easy. Okay. Let's talk about New England, the Suffolk system. There was some free banking. Some states in New England had free banking laws, but not all of them did. And they weren't among the really bad ones. But New England, interestingly, had an integrated banking system. Not because it allowed banks to branch. It also prohibited branching for the most part. But an entrepreneurial venture by one Boston bank called the Suffolk Bank created ultimately a regional banking system. This happened in the following way. The bankers in Boston, not just the Suffolk Bank, but other bankers, noticed that a lot of notes were circulating in Boston from banks in other parts of New England. And this was, as far as they were concerned, annoying because this was taking up space where their own notes might circulate. So the Suffolk Bank decided to start to aggressively collect notes of so-called country banks. Country banks was any New England bank outside of Boston. And they would gather them up and they would send porters with the notes to the bank and say, okay, we need, give us back some silver or gold, whatever. And they were doing this systematically with the intent of driving some of these banks out of business. They didn't mind whatever it took to, suppress their competitors. But eventually, the bankers and the country bankers in the Suffolk Bank came to an understanding. The Suffolk said, look, you establish permanent accounts with us in Boston. We'll redeem your notes, we'll accept them in the normal course of business, and we'll redeem them out of your account, which you have to then replenish. And they did. They all joined, almost all of them joined. And the result of this was that in New England, all the notes were circulating at uniform value because they could all be accepted at the Suffolk Bank. Oh, I forgot to tell you, this wasn't true in general. In general, because of unit banking, if you got a banknote from the Farmers Bank of Peoria and then you went out of state with it, it would lose value. So the currency wasn't uniform. The value would decline the further away you got from the bank, because anyone who took your note far away, if they wanted gold or silver for it, they would have to get it back to the one office where you could get gold or silver back in Peoria. And they would have to bear the exchange cost. Most of the discounts, they're called discounts on banknotes, the difference between the face value and what they actually were worth in the marketplace, reflected not fraud, not the fact that a bank would fail, because if anyone suspected that, the note wouldn't pass at all, but simply the costs of getting the note returned and redeemed in specie. So for most of the country, the currency wasn't uniform. And here again, the economists get it wrong. They say, see, that's what happens when you have a lot of different issuers. You get all their currencies at different values. But that's not true. We'll see even more clearly that that's not true generally when we look at Canada. But to go back to New England, in New England, they established a uniform currency with the help of the Suffolk Bank by making it a central clearinghouse that other banknotes could be redeemed at par. So from 1823 or 4, all New England currency was at full value. You could go from Maine to Connecticut, and your note would still be worth its full face value, because in Boston it's accepted at its face value, and that's such a center of trade that everything's going to go there eventually. So New England had probably the closest thing to a well-functioning monetary and banking system, not because it had free banking laws, but because it had more genuine freedom of banking, with a lot of different competing banks, large numbers of banks, and the help of the Suffolk system that helped to overcome some of the inherent problems of unit banking in a way that didn't happen elsewhere. But even New England isn't really ideal. It does have these restrictions on unit banking, on branch banking. There's no branch banking. It does have a lot of regulation. And of course, it's only a regional system. If we really want to understand, and of course, New England didn't escape the crises completely that affected the rest of the country, though it did better generally than other parts of the country during big financial crises. I should say that the Civil War changed all this. During the Civil War, they taxed away all state banking systems. The federal government got back in the banking business, not by establishing only one bank as they'd done in the past, but by establishing a new system of federally chartered banks called national banks. And so at the end of the Civil War, and let's talk about we were on the greenback paper standard for a while, but they resumed gold payments in 1879. We had the national currency system. So only national banks issue currency, and state banks exist, but they don't issue currency. And this was a crummy system, too. It's under this system that we have the major crises of 1873, 1884, 1893. Here again, if you study the crises, if you study the system, you find that a major cause of crises was the regulations now imposed on the national banks by the federal government. They also cannot have branches. They actually copied the state-free banking laws in this respect and in one other. The notes of national banks had to be fully secured by federal government bonds. So far, it looks like we have a federal experiment in phony free banking. But there's a big difference, and it's an ironic difference. In the bad free banking states, the worst ones, the problem was that the bonds that were eligible for backing currency were crummy. In the national banking system, that is the national version of free banking, the problem turned out to be the opposite. The bonds that had to be used to secure national banknotes turned out to be too good. Now, what do I mean by that? Obviously, the problem it can't be that if the bonds are good, that means they didn't depreciate. They appreciated. So it can't be the case that banks failed because the bonds they had to purchase lost value. That didn't happen. What did happen was the bonds became so expensive that it was not worthwhile for banks to secure more currency. And because the bonds had to be purchased for market value, but they are only eligible to back the notes for their face value. As the bonds, after the Civil War, the United States government started to run surpluses, the federal government. So they were making more in revenue than they were paying in expenses. The difference they used to retire the debt. Bonds, federal bonds, became more scarce, particularly the ones eligible for notes. Banks didn't bother to get any more because it was too pricey to do so. In the meantime, the country's growing and it needs more currency, especially in the autumn. In the autumn, you have a big peak demand for currency. No banks could afford to have bonds just to meet peak demands. They would only secure the notes to the extent of the permanent demand for currency, because otherwise their bonds aren't doing anything for them, and their yield is very low. So what happens? Every autumn, money gets tight. Sometimes it gets so tight that there's an outright crisis. The panics of 1884, 1893, and 1907 are all attributable to the bond deposit requirements on national banknotes. All economic historians know this. No other monetary economists get it. So this was the major cause of currency crises that ultimately led to the creation of the Federal Reserve. It wasn't because we didn't have we didn't have enough regulation of our banks. It was because we had bad regulation of banks. Same story as before the Civil War, only the details are different. Bad regulations caused the most bank failures. They caused the fraud before the Civil War. Between the Civil War or after the Civil War, up to the time of the Fed's establishment, bad regulations lead to severe, sometimes extreme currency shortages and crises. Now, you can get that just by closely studying the U.S. system, but you can't really get the whole picture until you look at another case. And in this case, the clear parallel to consider is what's happening in Canada. Now, I'm only going to talk about Canada after 1870 because that's when it became a unified, had a unified federal government for the North and the South. so that we can talk about Canadian banking as a single system. But it's how the Canadian banking system performed relative to the US system in the same period really reveals a whole lot. Now, Canada did not have anything called a free banking law. And in important ways, they didn't have free banking in the true Scottish sense or the Larry White, George Selgin, whatever sense. But they had a system that was free in many important respects, and much freer than any US system in many important respects. The most obvious way in which Canadian banking wasn't free was that they always retained the charter system, right? The system where every bank has to be approved by the government, has to be issued a license to do business by the government without a general incorporation law. However, the way they managed it at the federal level in government, in the Canadian government, was such there never have been any charges that it was a corrupt system, and any bank that met the requirements of the law would get a charter. They were pretty stiff requirements. You had to have enough capital, etc. It wasn't easy to start a bank, but it wasn't the case that you had to bribe the legislatures or anything like that. Mostly what the authorities were concerned about was ruling out outright frauds. And we know that they weren't too strict, because some banks did get started in Canada that turned out to be fraudulent. Some of its more serious banking failures were banks that clearly were never intended to operate as responsible institutions. They were small. They didn't last very long, but there were a few instances like that. Anyway, over time, Canada allowed its banks to branch not only in limited areas, but anywhere in the country. And they could issue notes on the basis of whatever assets they chose. So there was no difference between the assets that could back deposits and the assets that could back Canadian banknotes. This is very important, because if people want more currency for a Canadian bank, it's no problem. You reduce your deposits, you issue more notes, your assets, no change. You don't need to change them because there's no law saying they have to be different. This is very important in the harvest season. So the result is a system that's much more concentrated. America eventually had 30,000 banks. Now they've come back down because we've allowed branching finally since the 1990s. Canada, at most, had about 46, never had more. And yet the Canadian banking market was more competitive. Why? Because the banks all could branch. So every community, every banker wanted to be in every community that was sizable at all. Obviously, tiny towns didn't get banks, but they wouldn't have another unit bank. So all the banking markets in Canada were highly contestable. By the end of the century, every bank had branches in Halifax and Vancouver and you name it. They were all over the place. And whereas in the United States, you had 30,000 banks, but you might have many towns where there was only one bank. And effectively, it had monopoly power. So numbers can be very deceiving here. You want a banking market where there are a lot of where entry into every part of every geographic part of the market is contestable, where no bank can be sure it isn't going to face rivals. And that's what Canada had. Studies, by the way, have shown, I wrote about this recently, there's no evidence of monopoly power having been a problem in Canadian banking, even when the numbers of banks declined as they did in the 20th century, down to about, now there's like 6 or 5 chartered banks left, and then there are other institutions as well. But no study has ever shown any evidence of monopoly power being a problem in the Canadian banking system, despite the small number of banks. But back in the 19th century, we have it several dozen. And they could all branch and could all issue notes with no special collateral requirements. So what's the result of this? Well, first of all, there were Canadian bank failures. And if you just go by the numbers of failures as a proportion of total bank assets was already significantly smaller than under the national banking system in the United States. I mean, a lot smaller. But what's even more important, we shouldn't concentrate too much on the number of failures. A healthy industry will have failures. It's not the question. It's not that you want zero failures. But we should ask how many people lost money, especially from holding the notes. Because if a banknote system is going to work, people have to be willing to accept the notes without having to worry that if the bank fails, they're going to be stuck with stuff that's worthless. And the answer here is very clear. The losses suffered by holders of Canadian banknotes were minuscule in comparison with losses suffered by banknote holders in the United States during the same period. Minuscule. Most of the banks that failed in Canada were very small, first of all. The bigger ones tended to survive. And the sound banks tended to be bought by other banks. So in the end, you're left with pretty small banks. And even those banks often had enough assets to redeem their notes because they had capital as well, and that helped, right? That's part of the regulatory system. There was a regulation of capital, so that helped as well. There had been some cases where losses were suffered by note holders, and those were considered quite scandalous. And the most notorious was of the Home Bank. That was the one really big bank failure, was 1923. And I'll come back to that. But there were losses suffered on that bank failure. I'll come back to that. But let's go back to the 19th century and the early 20th century. The main thing to note here is Canada had no financial crises. They did not have a crisis in 1873. They did not have a crisis in 1884. They did not have a crisis in 1893. Even as the American market was falling apart, they had the same dollar, the same gold unit, but they did not have any of those crises. Now, what does this tell us? It tells us that the Canadian system, that the problems of instability in the U.S. system could not be attributed to the inherent shortcomings of a gold standard, because Canada is on the same gold standard, or to the inherent shortcomings of having numerous banks of issue instead of a central bank, because Canada had numerous banks of issue, not as many, but it had numerous and had no central bank. That's important. But how would you know that if you didn't compare the systems? 1907 was our worst panic in the United States, the one that really created the impetus for the establishment of the Fed. I could talk forever about what was behind that, why we ended up with the Fed instead of Canadian-style reform, but I will just mention that many people between 1907 and 1913, when the Federal Reserve Act was passed, tried to get Canadian-style reforms in the United States, not a central bank, and all of those efforts failed. I have a paper you can read called New York's Bank, all about what happened. But I don't have time to go into it now. Let's talk a little bit more about what happened after 1913. In the United States, the decision was made to solve our banking problems by creating a central bank, 1913, Federal Reserve. How well did it work? Well, between 1913 and 1933, we had more banking crises, more crises and more failures than in the 20 years before, which were 20 bad years because they were the years that had people say we need a central bank or something. It got worse, not better. Peak bank failures were in the 1920s and early 1930s. Thousands. In the early 1930s, in 3 years, 9,000 banks failed in the United States. And in the 20s, we're only a little bit better, but 5,000 banks failed in the entire 1920s. It's true that we had 30,000, so 5,000 is, it's 1/6, but that's still a big number, right? Canada had one bank failure during this whole time. The home bank in 1923, the one I mentioned before, it was bad. It was the biggest bank failure in Canada. It wasn't the biggest bank. There were most of the chartered banks were bigger than the home bank, but it was the biggest bank that ever failed in Canada up to that time. One of the things that Canada didn't have that might surprise you, it didn't even have ordinary bank inspections. One of the things they did in 1924, a rather modest response to this horrible failure, the worst that they've had, was to have government inspectors inspect the bank's books every year. This is a regulation I think you can be a hardcore libertarian and not be too upset about, right? It's a way of making sure that the banks books are in order and anything. Well, that seemed to help because there was not another Canadian bank failure between then and 1982. This is before the Bank of Canada, and this is before deposit insurance. I'll talk briefly about those in a moment. But up till 1935, Canada has no central bank, and it has no deposit insurance, and it has not had a bank failure since the home bank failure of 1923. No bank failed in Canada during the Great Depression. Now, you'll want to know why the Bank of Canada was established in 1935. It had nothing to do with the failure of the existing banking system. Nothing. Completely unrelated to that. It was briefly a story. I don't want to talk too long. How much have I talked? 8:50. Oh, I've talked too much already, but I'm almost done. It was a story. We started at 5:30, so I haven't talked too much yet, have I? We started at 8. I mean 8, yeah. So 8:50. Okay. I'm going to stop soon. The Bank of Canada was established in 1935, mostly because of pressure from international authorities, especially in England and the United States, who were going around saying every country has to have a central bank. For that reason, and also as a sop to inflationists who were putting pressure on the government to issue more government currency, they had a government currency called Dominion notes, the Bank of Canada was created as a kind of political compromise. There was no economic justification for it. Then, and it played no role in avoiding bank failures in the 30s because it didn't have to. In 1967, Canada adopted deposit insurance. I have an article, you can read about that. Politics again. Had nothing to do with the failures of the banking system. So if you look at the Canadian experience, you can really see how little regulation is needed. Some, but how little to have a sound banking system, and how false the story that's told about the U.S. of lack of regulation causing problems, how false that story is, and also how false the story of the gold standard being an inevitable source of financial crises and instability is. Because if that were true, if that were the reason why we had crises in the U.S., Canada should have had them at the same time. Similar economy, less diverse. So you can learn a lot about banking history and about what freedom does and doesn't do in banking by closely examining what happened in the U.S. But if you look at the U.S. and you look at Canada, you can learn a lot more. And of course, if you look at other countries still, you can learn even more than that. Good banking and monetary theory require familiarity with banking and monetary history, not just in one place, but in as many places as you can learn about. Thanks. I'm sorry I went a little bit over. I hope that I won't prevent people from having time to ask questions.
All right. Thanks for your time and your talk.
You're welcome.
So, what you said, it all sounds all too well, right? I'm sure you've read some of the criticism on Canadian free banking that notes did not command their full value. And
What's that?
Banknotes, they did not command their full face value. They did not exchange at full face value sometimes. And also there were some counterfeiting. I mean, that's what the critics what the critic says. What do you have to say to that?
Well, Canadian banknotes did have discounts early on because the banking system wasn't, instantly developed for the whole country. So you can imagine if you took a note from Halifax in 1870 and you went to Vancouver then, there might not be any branch of the bank there if there was a bank at all at the time. So the system had to grow, it had to develop, and you needed to get improvements in transportation, you needed railroads. But even so, with many fewer lines, Canada is geographically almost as big as about the same size as the United States, but had much lower population, like 1/10. So it's going to have less of a railroad network, less populous towns, etc. Yet, by the early 1890s, every Canadian banknote was worth its full face value anywhere in the country. So it's not true that the notes were discounted. I mean, after 1890. And it's ridiculous to expect the notes to be par everywhere before you have railroads and before towns have anything but wolves living in them. I mean, it's natural. It's economical to say to somebody, look, you can live in a town where there's nothing but wolves, but you're going to pay a price where your notes are going to be worth a little bit less. Counterfeiting, every currency has been counterfeited. Bank of Canada notes are counterfeited. Federal Reserve notes are counterfeited. So, the people will say, oh, you had all these counterfeits of banknotes in the past. Okay, let's suppose every bank's notes were counterfeited. That's 100% of banks' notes were counterfeited. Today we have one source of notes and they're counterfeited. That's 100% also, last time I checked. But I can tell you that a free banking system is much less conducive to counterfeiting, much less. And that's why there was a lot less counterfeiting in Canada. I asked the curator of the museum, sure, they can show you examples of counterfeit notes, but and the figures on how many counterfeits there are, of course, all speculative, right? But we know the following. Counterfeits get detected when they pass over the counter of the legitimate banks where the tellers are trained to spot the fakes. That's when almost all counterfeits are detected. When you have a free banking system like the Canadian or Scottish system, or a system like the Suffolk system, notes that are issued stay in circulation only for a brief period of time because they inevitably get deposited in a rival institution, cleared through the clearing system, whether it's a centralized system like the Suffolk or not. There were set clearinghouses in Canada also by the end of the 19th century, and then they're returned. In the Suffolk system in 1830, a note would stay out in circulation for 10 or 11 days only, hardly longer than a check might stay in someone's wallet before being cashed. That meant that there were perhaps 3 or 4 transactions between the original insertion of the note into the economy and its passing over the counter of the bank that it's supposed to have come from. So the teller gets the note and says, this is a counterfeit. Where'd you get it? 3 transactions. The risk of the counterfeiter being identified and caught is very high, because there are only a few transactions before detection. This is extremely important. Now, a central bank note will stay around in circulation until it's a rag, and only then will be returned to its source. Could be a long, long time. No way you would find out where it came from. It has passed through hundreds of hands. So counterfeiting, you want to discourage counterfeiting? Have a competitive banking system. It's much better. And also, what the competitive banks, what the Scottish banks did and the Canadian banks did, they wouldn't punish you if you turned in a fake note. They would give you credit for it because they wanted to catch the bad guys. In the federal government, if you're so stupid, if you think you have a counterfeit, pass it off to somebody. Don't bring it to the government because they'll say thanks. You'll be lucky if they don't arrest you. And so, and we don't, our government, and governments don't say how many counterfeit notes are out there, but you can bet that it's a lot more than you think. And same with coins. I mean, I don't know about the euro coins now, but I remember the British pound coins. 1 in 8 was fake at a certain point. 1 in 8. You could take if you had a bunch of them in your pocket, you could stack them up, and there was a way to tell which ones were fake. And chances are, if you had 8 of them, there'd be a fake one in there. So governments have not done a good job suppressing counterfeiting through monopoly. So that's the answer to that.
All right, that was a softball question. Now comes the tough one. Why do you think option clauses did not develop in the free banking period? Like the way they did in Scotland?
They weren't necessary. The option clause is a clause on Scottish banknotes, was outlawed in 1865. But before that, some Scottish banks issued notes that had a clause written on them that said, this note is redeemable on demand or in 6 months with the payment of interest during this time of the option is exercised. And the interest rate was the maximum usury rate. And the reason those notes existed, remember, this is a long time ago, this is the 1750s, was not to avoid panic, to suppress runs or end runs. They could have done that. It was for other banks that would try to raid your bank. So remember when I talked about the Suffolk accumulating the notes of rival banks and trying to bankrupt them by redeeming them all at once? That kind of thing was done in Scotland by some banks trying to suppress new rival banks, especially. So if you were starting a new bank in Scotland and you wanted to not be a victim of some established bank accumulating your notes just to drive you out of the business when you were just getting started, you would issue an option clause banknote. That's what those were for. They were suppressed. There was no good reason for suppressing them. They didn't cause any trouble, but they were never used to invoked against ordinary customers. They never had to be. So in the Canadian system, by the time the Canadian system is established by the time we're talking about in the 1870s, things are already more orderly. There are no note raids going on or anything like that. So there's simply no reason for optional clauses. In theory, these are contractual devices that can contain panic-based runs. But this goes back to Diamond and Dybvig. There are hardly any panic-based runs. That's a misunderstanding of what happened in the United States, and it's an even greater misunderstanding applied to other countries because it's even hard to find runs. Most runs that have occurred on banks have been runs on banks that were in trouble before the runs. That is, people have known which banks were sound and not. Usually the sophisticated depositors are the first to stage a run. They take their money out. Only belatedly do the regular people start to get the word, and then they might show up. They're always late. The only group that's later than the regular people is the government. The government is always the last to figure out that a bank's in trouble. They notice when they see the people in line. And so the whole story of banks being vulnerable to people suddenly panicking because of a false rumor and all that, that's all historically nonsense. When Diamond and Dybvig wrote their article, which is an article I detest, I'm always arguing with David Andolfato about it, because his view is an article that makes you think is good. I say not if it makes bad government policies proliferate. In this case, deposit insurance. That article is a good example of the kind of banking theory you do when your history is false. They thought they knew the history. They thought, okay, we know that people panic and run on banks for no reason. How can we model this analytically? And they tried to do so. It turned out they had a hard time, because if you look at the model, it turns out it doesn't actually prove what it's supposed to prove, and it's relatively easy to show that if you change the conditions, there won't be any runs. But they tried to make a model like that because they thought they were modeling reality. And they were modeling their own misunderstanding of history. And unfortunately, because from then on, now if you read any number of articles, and they'll say, of course, banking systems are inherently vulnerable to runs. See Diamond and Dybvig. It's now a fact. It was a myth that got turned into a model that got turned into a fake fact about reality. And I hate it, as you can tell. Yeah.
Great talk, George. Actually, about Diamond and Dybvig, you have demolished them in a few of your writings, but I feel it is necessary to make it better known, your criticism. It's what you say. Many people say, oh no, Diamond and Dybvig have proved that you need deposit insurance or central bank or whatever.
I got so tired of refuting that I wrote the article, so now they say, see Diamond and Dybvig, and I say, see Selgin. But maybe you should do a Spanish version. That would help.
Regarding, you always explain this, what's not really free banking, the unit banking thing, and the government debt. I can understand the public debt requirement. They are interested in getting their financing easier. But why the unit banking? Were they afraid that they would become big or very powerful?
This was just the lobbying of the established bankers. The first guy who gets a bank, it's already saying, don't charter any other banks. And so obviously in some areas this lobbying was more successful than others. But one of the things that the industry was able to lobby for was, if we have to put up with other banks being chartered, let's at least make sure that they can't branch, because then they can go anywhere. So you can imagine how you could have log rolling with all the established banks getting together and saying, let's not allow branching. So this way, when new banks are established, one of the things they would do, they said, one of the rules would be, if you want to get a charter, you have to show that the town needs a bank, right? Well, okay, if it didn't have a bank, then maybe you would get a charter. But no one under that system was going to allow branch banking, because that would mean it would become meaningless to try to limit new banks to towns that didn't already have banks.
And were there no criticisms back then when those small banks failed, that the explanation went, hey, you are too small, you're localized, you're not diversified?
There were efforts to introduce unit branch banking throughout this whole period. Steve Horwitz and I wrote a paper, I think it was 1987 or something like that, or 88, called Interstate Branching, the Reform That Won't Go Away, that documented how all the failed efforts to overcome these limits on branch banking. And of course, a decade later, they were toppling, not because of our paper, alas, but it was still the case then that these restrictions were, for the most part, still in place. But no, there were plenty of economists and others who said, this is really bad. We need branching. And many of them referred to the Canadian case, especially later on in the 19th century. There were many, many good economists in the United States who knew all about what was happening up north and used it to argue for reforms like branch banking, for getting rid of the bond deposit requirements on notes, and for other kinds of banking freedom that Canada had and we didn't. There were plenty of people at the time. I think they understood things better back then than we do now, except for our economic historians, who are very good, but not enough people read them.
I've read a lot of what you have written about not only theory, but about history of banking. But what I miss is the point of view of the customers. I mean, you always write from the point of view of the bank and maybe their relationship with government, and maybe sometimes big businesses show up. But it might be useful to have something available about who were the customers. Was everybody a customer? Like today, everybody has a bank account and we use it for everything. But I guess it was not the same back then, 1 century, 2 centuries ago. Then also, why is the United States system so different that they use so much cash and especially so much check? Yeah. You get everything by check, while in Europe, you got the money from your employer directly into your bank account and stuff like that.
It's changing slowly in the United States, but checks are now, with the younger people, don't write checks anymore. And now, if you're in the supermarket line and somebody's writing a check in front of you, you are entitled to get angry about it because it's really, but it's usually somebody older who just doesn't want to use a debit. A lot of people are afraid of debit cards because they carry more risk than credit cards, and a lot of people don't like to use credit cards too, for some good reasons. I don't like to use credit cards. I always use my debit card, so I take a slight risk. But I don't like credit cards because I don't like owing money to people. So I'm a little old-fashioned too. But checks are going out finally in the U.S. We've always been behind in a lot of our payment services. We're very backward. We're backwards on telephones too, for example. But to get to your question about the customers, we have to remember that the banking systems we're talking about, anybody who used banknotes, who used current paper currency, was a sort of a customer of a bank, whether they liked it or not. And so one of the more interesting topics that we focus on is how sound were the banknotes, and that's probably the thing we've been emphasizing more than anything. I mean, Larry and Kevin and Steve. But as for the other customers, deposits were generally kept by more well-to-do people, as you can imagine. The poor people didn't have enough to bother with bank deposits. But it's quite surprising. I know more about the Scottish case here than the Canadian, but it's remarkable how little you had to have to open a bank account in Scotland in the 19th century, early 19th century. And the Scottish banks really did try to encourage people to save and make it easy for them to do so. They were, most importantly, I think, from the U.S. perspective today, the banks in both Scotland and Canada were very good, really very good at banking the unbanked. We now have this big thing about banking the unbanked because some people still don't have bank accounts in the United States. But one of the things that helped was the banknotes. People would get used to dealing with banks through being customers holding their notes. They learned to trust the banks through learning to trust their banknotes. And that made them a little bit more willing, once they were able to keep a deposit at the bank, because it was really the same institution and similar risks. And so banknotes were an important device for building the market for other banking services. And of course, it's a device that's no longer in existence. So I've thought about writing a paper about the role of free banking and helping to bank the unbanked. And of course, branch banking is all about that too. You know, it's all about building the market. But I haven't written that one yet. So I think there's a very important, I think from the customer point of view, ultimately, that's all I care about. what's the welfare implications for ordinary people. But I think that as far as getting people to trust banks, to deal with them, and making it easy for them to do business with them, free banking also was very, very good compared to what we see today.
Not sure how much time we have. Thanks, Joachim. Okay, now here. First of all, George, thank you so much. I think it's been very interesting. My question is a quick one. What is your view on the current situation today?
On the inflation?
No, current situation of the banking system today. Do you think...
Where?
Worldwide, I mean...
No, that's not a quick question.
US or Europe?
Yeah, that's so broad. I don't know how to begin, I certainly better talk only about the United States. I think we don't have a very good situation because we have several dominant, very large banks that are clearly too big to fail, and that's a problem. And then we have this tiny community banks that are kind of like the unit banks of the olden days. That have their own vulnerabilities. What we don't have is, middle-sized banks that are not big enough to be too big to fail, but big enough to be reasonably diversified and strong. So I'm afraid that our banking system is structurally is not in good shape today. Not in good shape. It fails the Goldilocks test. It's and I don't know what we can do about it. I think ultimately, I've given up on free banking for the United States. I never did believe we would have anything like it again. I think this future lies in stable coins, and that's a whole different topic, of course. But the closest thing, the best hope we have for having something like a competitive, market-based alternative to banks as payment service providers is the development of stablecoin-like substitutes. And right now, those are in a very precarious situation because of poor arguments comparing them to Wildcat Banking and that sort of thing, among other things. They haven't been adequately studied. There's a lot of misunderstanding about them. There's a lot of hysteria about them being vulnerable to runs and all that Diamond Dybvig sort of stuff. And so a big challenge is to try to save these. There are going to be some rotten ones, of course, but you want to be able to make the world safe for good stable coins if we're going to have some real alternative exchange media that might develop into something better than our bank-provided stuff or central banks provided stuff.
Muy bien, ¿alguna otra pregunta? No, bueno, pues muchísimas gracias, profesor Selgin.
You're welcome. You're all very welcome.
Bueno, pues muchísimas gracias a todos los que nos seguís también desde YouTube. Y nada, seguir todas las actividades del Instituto Juan de Mariana, haceros miembros, formar parte de esta gran familia, y gracias también a la Universidad Francisco Marroquín por habernos acogido. Gracias a todos, hasta la próxima ocasión.